Welcome everyone to this Systemic Risk Center event on the SVB Bank and the global consequences thereof. The Systemic Risk Center has been founded to look into anything which makes the market not function perfectly, which risks the well-functioning financial markets and beyond. And this time around, it all started at SVB, a systemically unimportant bank with a dysfunctional asset liability management, no CRO for a while, poor liquidity management, and markets did their job and took the bank out. Doesn't seem to be a Diamond Diptych type run, but the bank had no financial channels to directly infect others, and yet here we are on this webinar all together because it did infect others. And so the question now is going to be, and our panel members will answer these questions, I hope, is it just simply the fact that we are now seeing who is swimming naked now that the tide of low interest rates has gone out? Or is there more subtle contagion happening that we haven't actually quite understood yet? So this panel we have in front of us is the illustrious panel, exactly the right panel we would have chosen to answer exactly those questions. I did not direct the panel to say anything. They will choose to answer and comment on the most intriguing facts of the current crisis. If you want to tweet, the hashtag is LSESVB. And we'll start with Charles as the first speaker. I will not make any introductions. You know who they are. And I just want to say that Charles and John wrote a blog on this particular question, and the link will be put into the chat at some stage. Charles. You're muted, Charles.
Right. So thank you, JP. The press has been full, almost ad nauseam, with discussions about the implications of these banking difficulties, having begun with SVB, for interest rates and monetary policy and for inflation and how to deal with it. I want to turn to a completely different aspect of these problems, which is the regulatory structure that we have and the problems that it now faces. After all, we thought we had an agreed process for dealing with failing banks, which was known as a bail-in process. And that bail-in had a clearly designated order for which bank creditors would receive a haircut in order to deal with the losses that the bank has made. Now, we've had two countries with two problems, the US with the Fed, with SVB, Signature and Silvergate, and now Switzerland with Credit Suisse. In neither case was the bail-in process followed. In the case of the US, SVB was not, as JP indicated, described as a systemically important bank. It was the 16th largest bank in the USA, a middle-sized bank, and yet its failure was described as systemic, and rather than follow the bail-in process, effectively the Fed undertook a bailout process. With Credit Suisse, the order in which bank creditors should lose their money in the case of insolvency was turned upside down, whereby the CoCos in AT1 were completely wiped out and the equity holders were not. What this clearly indicates is that whenever there is going to be a problem, the central banks are not going to abide by the bail-in process. It has been tried and clearly, according to the central banks involved, has failed. Indeed, as I think JP indicated, the situation in the US is now that almost any bank is going to be subject to this systemic exception. Now, any bank, whatever size. So we're going to have to completely reconsider the structure of regulation because bail-in has tried and gone down. Another feature of all of this has been that government securities have always been described as not needing any risk weight because they were safe and riskless. And what we have seen very clearly is that there can be enormous interest rate risk, and unless, and of course, until that is hedged. And that means that the risk weighting of government bonds, depending on its duration, also needs to be considered. And that will cause a fascinating difference of opinion between governments who never want to see their debt obligations subject to any kind of risk weighting, and supervisors, regulators who from now on have got to be cognizant of the riskiness of government bonds, because that was really what brought SVB down, that and the fact that they abandoned their hedge for reasons of trying to make their accounting profits look rather better at an earlier stage. So I'm to conclude, my concern about all this is not so much the macroeconomy issues, which I think have actually been slightly overblown. I do think that ultimately the banking systems in our countries are relatively strong and stable, and where there are problems, they will be protected. The problem is that we no longer have the kind of regulatory system that we thought we had, and we need to reconsider it all almost from first principles again. And that's enough from me.
Thanks, Charles. Lutfey, you're next.
Thank you, JP. Thank you, Charles. And I have to say, because Charles is in the room, that clearly the plethora of risk indicators that were meant to help us here have failed to do so. So they've suffered from Goodhart's law, as Charles would have said in a macroeconomic context. I want to focus on the micro, more micro, less macro on what's going on here. And I want to preface it all by saying that I think we're in the thick of it, things are playing out. So too early for answers, but I think we need to ask some pretty robust questions. We're talking about systemic risk, and I want to address both halves of that phrase. In terms of risk, if risk is deviation from the expected, I think we should acknowledge that expectations have been conditioned severely by a decade of QE. And it's at least a decade of flood of funding and a super flood of funding in the 18 months after COVID. And now that we see an unwind or an inversion of that, symbolized by the yield curve, short-term rates up tenfold, the curve inverted by most in 40 years, it's a symbol, but I think we need to update our mental models in all sorts of different ways. And the shoe is dropping, or the shoes are dropping from that inverted shoe rack in all sorts of different ways. One of the hallmarks, unfortunate hallmarks of that period has been a neglect, spurning, and a demotion of the depositor in the financial system. Please hold, your call is important to us, but your funding is not as important as it used to be. Because now we have other sources. So depositors became a bit of a sideshow. And what was more visible and salient when they looked at this system are two things. One is the focus on regulatory compliance and metrics. Annual reports are full of those. And the second is basically a lot of technobabble, futurism, digital this, digital that, efficiency drives on the part of CEOs of some of these banks. And you just have to look at some of the people running these organizations. The focus is more on internal plumbing and operations. If the CEO has a moniker of, so-and-so, the knife, that is meant to be a good thing. And, you sort of take your depositors for granted that they're going to stick around until I'm done with the transformation of the bank. And less of a focus on some of the, I suppose, the softer issues of culture, leadership, credibility, trust building, communication, which I guess were not seen to be sexy because there isn't a direct counterpart in capital ratios. Whereas as we know that they can act as the circuit breakers or the risk amplifiers when we really need them. So I think we need to borrow a lot from the domain of behavioral science. And I know that we'll be looking at it more closely going forward. What has been the role of personalities? And I'm thinking of CS in particular right now, biases, the context, the composition of the board, the executive leadership, the background, the competence, have they worked together before? Could there have been effective challenge on the board? That sort of stuff. And then how they've dealt with information cascades. one of the hallmarks of this era, as opposed to 10 or 12 years ago, is that Twitter is a fixture. We cannot blame Twitter when things go wrong. So how do we deal with information and communication cascades? Over here, we've had at least 2 examples. You'll remember one of them was, oh, we've discovered irregularities in our reporting systems, but they're not material. And then the SEC calls and, oh, actually, they are material. Then the market reacts and it goes, actually, they're not material to this year's financial report. So imagine from the depositor's point of view, how is this communication being received? And then, of course, the regulator has a lot to answer for. I think it's not just the regulation. We've got to ask whether they're part of the same echo chamber as the regulated. Unlike SVB, Credit Suisse was not systemically important after the fact. They were one of the only 30 GSIBs designated around the world. And so how is it possible that you have an annual report and a Pillar 3 risk report from just a month prior that shows a bank that is fully compliant, doing really well, a bank that was clearly solvent enough for the central bank to offer 50 billion of liquidity to them just 2 days prior, to sort of vaporize in this manner. So I just want to finish off by saying that I think this was as much a run on the regulator as it was a run on the bank. Clearly, depositors were not convinced by the endorsement of liquidity and other rhetorical measures. And maybe as we do a postmortem, we need to think of regulators as being part of the system, not apart from it, and maybe borrow from the NTSB in the US, where after a plane crash, the agency that investigates it is not part of the Department of Transport. So you have a separation between the post-fact investigator and the regulator. So yeah, we need to ask these uncomfortable questions without necessarily prejudging the answers. And I would urge that we ask them not just on the concrete side of things that is familiar to the finance domain, but also some of those softer issues that I just mentioned around culture, leadership, credibility, communication, relationships, and really restore depositors as the key constituents of the system that might just prove to be the key to averting systemic risk. So I'm going to stop here.
Fantastic. Thanks, Lutfey. Ron, your turn.
You're on mute, Ron.
You're muted, Ron.
Thanks very much. Charles and Lutfey have made several good points, and I agree to a certain degree with them. But I think I want to go back to the issue of, can we say now that this was a failure of the regime globally, regime that we put into place after the great financial crisis? I think that we shouldn't jump to conclusions too fast here. We need to dig more, and the Fed has promised to do so. What we can say is that the Fed thinks that there are serious problems somewhere, and they want to find out where those problems really lie. What I think we can say at this stage is that there was a failure of supervision practice in this case. Now it's widely documented that the Fed had already noted risk control problems in SVB as early as 2019. People on the outside were communicating to the Fed that these are serious problems. BlackRock was retained maybe to try to help to push back a little bit on the pressure that SVB was holding. BlackRock was retained and did a risk analysis of their systems, and they basically said they are behind their peer banks on 11 of 11 categories that they evaluated, and that on 10 of 11 categories, they were very far behind. So they basically said, you fail. But nevertheless, not much changed in SVB. So, okay, consultants are often ignored by management when they don't like the message, but how could the supervisors be ignored? And here, I don't think there are any good excuses. And you have to wonder about it. So were supervisors too lax and didn't follow through when they could have done? Like the supervisors specifically who went and looked at the situation at the SVB, could have they escalated their concerns and get attention within the Fed? Maybe they just said, well, no, we filed the report and that's it. Perhaps that happened. Did the supervisors, on the other hand, think that these were serious problems, but felt that senior managers weren't really listening or not in the mood to listen? That supervision from the point of view of the board was really about the systemically important banks, and we're not, the regional banks can take care of, the regional Federal Reserve banks can take care of the regional banks. Maybe that was going on. Did the fact that Greg Becker, the CEO of SVB, sat on the board of directors of the San Francisco Fed, allow him to deflect some of the criticisms and maybe slow down the process? Maybe that was true. Actually, maybe all of those were true. And so Vice Chairman Barr has got to come up with a report in May and tell us what the Fed thinks about this. And I think the whole community, following Lutfey's point of view, is going to have to look at how plausible the Fed's analysis is. Have they really been thorough? And they should be prepared to basically not accept it at face value, because there could be, unfortunately, just some blame game going on, and they're trying to avoid some of the heat. Now, one thing I wanted to say about Charles' report is that he basically said the regulatory system that was put into place after the Great Financial Crisis was a bail-in system. Well, I think that's too short. Bail-in is a specific tool that was added to the toolkit, but there were many other things, and we have to emphasize the importance of the efforts to introduce systemic stress testing as part of the procedure. Also the living wills and all of these kinds of things, which were strongly interventionist into the functioning of the way banks operate and so forth, and were the focus of a lot of the pushback that was received from the banks. So certainly those were important parts of the system. And in the case of bail-in bonds as such, the case of Credit Suisse here is an interesting one in the sense that, well, what's bail-in supposed to be? Well, subordinated creditors would have themselves rapidly bailed in and taking on equity type positions if it was important to resolve a bank in distress. Well, it worked. It worked in the sense that a solution to the Credit Suisse distress was found, okay? Now, in the coming years, we're going to see perhaps litigation, probably we'll see litigation, and that will play out as it should. But in the meantime, there is a response. There's a new bank, and there's a new bank that has been put in charge. And we're not having to deal with a mess like we had with Lehman Brothers, okay? So I think that needs to be recognized. And I should say also this idea that that the shareholders in Credit Suisse did get some not 100% write down of their securities and so forth is consistent with academic views about optimal regulation, because basically an old style view about crises is that there are two equilibria possible, the good ones and the bad ones, okay? And a bank run is a bad equilibrium. And the risk that people are worried about is largely credit risk, where you have illiquid positions that in the long run probably are going to be good, But if there's a run, you need to liquidate that very quickly, you're going to make huge losses, okay? And so the idea is that if you have a bankruptcy regime that allows the bank to be restructured fairly efficiently, there could be some upside for equity. And the theoretical way that should be dealt with, it should be through an award of warrants, not new stock. So I give the Swiss authorities a B- on this, but it's not an F, okay, as far as I'm concerned. And I think probably I should stop there and move on to the other people.
Excellent. Kathleen. You're muted, Kathleen. Yeah.
Okay, first thing to note, Silicon Valley Bank was not a small bank. It's called a regional, but that's only because they got the rules changed for themselves so that they wouldn't be systemic. They actually bought the rule change. So the first thing to recognize, they were the 16th largest bank in the United States out of 4,800 banks. And they were core to the venture capital sector, not just in California, but globally. The UK branch had half of all UK venture capital and associated founder companies, and the founders themselves as personal depositors. So that's a huge systemic concentration right there. And their business model was highly focused on that venture capital sector, and they were excessively concentrated there. They engineered customer loyalty by attracting deposits. Hold your seed round, your Series A round, your Series B round, your IPO as a deposit in Silicon Valley Bank. And, well, we'll give you a very heavily discounted mortgage on that Bel Air beachfront house or your Hampstead mansion. And we'll let you use your equity to buy that Maserati you so richly deserve. So there was a symbiotic relationship between the VC sector and SVB, the way they did business. They also attracted enormous numbers of foreign founders because, unlike most banks in the United States, they did not require a social security number. So foreign founders could get accounts at SVB where they couldn't get accounts anywhere else. They had a high concentration there as well. So they created an ecosystem around themselves. And they were very unusual in many ways. Just 6% of SVB deposits were covered by FDIC deposit insurance under the limit of $250,000. That's 94% of deposits were uninsured. That compares to a community bank average of 71% of deposits being within the limit and insured. So that, again, makes them an outlier. And just 35% of their assets were loans. Only 10% of those loans were commercial loans. So 25% of their loan book was personal loans or mortgage loans or other loans to founders and VC. And the rest of the book, 65%, was invested in what were sold as very, very safe government bonds, mortgage-backed securities, but skewed towards the longer tenor. And that's where their problem arose, because they had interest rate and duration risk that was not adequately hedged. They had a bit of a hedge that diminished as hedges got a lot more expensive as rates rose in 2022. They also didn't have a chief risk officer for 8 months, which didn't help. They were badly managed, but they weren't badly managed on average compared to most of the sector, because a lot of banks are suffering from the same duration risk mismatch in confronted with the highest, steepest hike in rates the Fed has ever done. So SVB at core made the mistake of trusting the Fed when the Fed said rates won't rise and inflation is transitory. The bond portfolio devalued at speed in 2022. This wasn't a problem as long as there was no run, because a hold to maturity book doesn't have to be marked to market. One reason for maybe not hedging so much is that any hedge did have to be marked to market as a profit and loss. So there was a mismatch in the accounting treatment of hedges and the hold to maturity book. Supervisors didn't take any action because, let's face it, the problem is common to thousands of banks. And then the Fed continued hiking. It sold. What happened next 2 weeks ago on the Wednesday was that a venture capital newsletter questioned the stability of the Silicon Valley Bank balance sheet. Founders and VCs spread the word over WhatsApp and Twitter, and $42 billion in outflows of deposits occurred over 2 days. Now, no bank can withstand a run at that scale, at that speed. Silicon Valley Bank had to sell off its hold to maturity book. That then realized the losses of 30 to 40% on those assets and put them in an untenable position, so that by Friday, they were done. This is the first bank run at Twitter speed. And I think that's something we're going to have to think carefully about. No bank survives a run. Certainly no bank survives a run at Twitter speed. Distress is then moved very quickly to destabilize the wider sector. Secretary Yellen observed that first New York and California came under stress, and then uninsured deposits came under stress everywhere across the heartlands. So this became a nationwide stress in the banking system in uninsured deposits. So stabilizing the system was probably the right decision, but I'm going to put a caveat here. This looks a lot more like long-term capital management to me than it does like a Lehman moment. Silicon Valley Bank billionaires called the politicians and the regulators that they were their friends, and they had a lot of friends, and they put pressure on them to cover the uninsured deposits. So to me, this does look a bit like LTCM, and that's something to think about in terms of, have we really changed the system if it retains crony capitalism at its core? Here in the UK, HSBC got a great deal. They bought half the UK venture sector for £1 and got relaxation of the ring fence. But on the whole, I'm glad they did, because I don't like to think of the UK's future if they lost the only dynamic part of the economy that's investing new capital in growth business. We don't have much of that. It would have been a big hit to lose it. So did SVB invest about depositor funds in risky assets? No. In fraudulent loans? No. They might not have been a very well-managed bank, but they didn't actually do anything particularly horrible. They're probably worth bailing out. What worries me is that we've seen the Fed balance sheet balloon by $300 billion in the week that followed. And that eliminates half of quantitative tightening that's been observed since they started QT. And then, of course, the crisis spread globally, putting Credit Suisse under increasing instability. I remember the first blog post that questioned Credit Suisse in October of last year that spread virally and that has destabilized Credit Suisse ever since. Again, we have a crisis and a run moving at blog speed, at tweet speed, and imperiling very large systemic institutions. So one question that I'm left with is whether 4,800 banks is the right number of US banks. Canada has 5 very boring, very large banks and has never had a banking crisis. On the other hand, Canada does not have a dynamic economy, has very low innovation. So ultimately, we have some political choices to make, because I think that we can keep changing the rules, but we're not fundamentally changing the systems. And the question is whether the systems are serving the billionaires or serving wider depositors and serving growth in the economy.
Thanks, Kathleen. John, your turn.
Thank you so much, JP. And what I find interesting about a crisis like this is how many new things you learn and all the new interests you develop. Just last night, my wife was asking me about AT1. So I mean, she's never had any interest in finance before. So clearly this is a new area of interest and could be quite good going forward. Now, for more precisely, I mean, I have been thinking about the financial regulation for a long time, and this crisis gave me a chance to hone my argument. And just to repeat what JP said in the outset, Charles Goodhart and we wrote a blog piece that has not been posted into the chat that reflects what I'll be saying here. To start with, neither Credit Suisse nor Silicon Valley Bank should have failed. We were promised this would not happen again. Mark Carney himself said some 5 years ago, over the past decade, G20 financial reforms have fixed the fault lines that caused the global financial crisis. So is that true? And that's what I want to question here. So the way we approach financial regulations is by what we call the modern philosophy of financial regulations. The idea is that you identify and measure all important risk, and you use that to fine-tune the appropriate level of risk in the system and increase risk if you need more growth, like in March 2020, or reduce it as we should have done before 2008. I think this case of Credit Suisse and Silicon Valley Bank challenges that modern philosophy of regulations. And to sum up, what do the authorities want out of financial policy? Well, they want the economy to grow, at least to avoid a recession. Inflation needs to be around 2%, and financial stability needs to remain high. Over the past decade after the 2008 crisis, all of these three objectives were in sync. So you could meet all three objectives at the same time, but that was always illusionary. And it was certain that at some point in the future, the three objectives of financial policy would conflict. And then what is the authority to do? And I think the financial authorities today have absolutely no good options. If they want the economy to grow, to meet the first objective, they have to disregard the other two. We have to keep funding costs low, with limit interest rate rises, and you have to keep the cost of lending low by keeping capital low, which undermines systemic risk. If you don't want the economy to grow, but if you want to fight inflation, well, then that's recessionary because the cost of lending increases and financial stability suffers because the bank's capital position erodes. Or if you want to prop up financial stability by raising capital, then lending becomes too expensive and growth is curtailed. All of this was foreseeable and all of this was avoidable. And I would have thought that the purpose of housing regulations and monetary policy in the same organization was that they could deal with the entire problem together rather than having two separate institutions dealing with two parts of the problem separately. So therefore, what undermines that mission on a more technical level is that the financial authorities, when it comes to regulation, face two key problems. The first is that the financial system is in effect infinitely complex. That means you can only patrol a tiny part of it. And if you de-risk one part, well, the risk emerges elsewhere. And if you try to squeeze all risk out of the system, you destroy the economy, not viable. And secondly, it's based on the notion that if you want to regulate by risk, you have to be able to measure that risk. But the problem is you can only infer risk by how prices move in the past. And for that, you need an inaccurate model, and you have an infinite number of candidate models which all look equally plausible ex ante. And that is really what is causing difficulties for the authorities. And then how will we take this forward? I see four possible options. And I think the most likely, and perhaps the worst option, is we will simply ramp up on existing regulations, we'll raise capital, make regulations more intrusive. That will calm market distress in the short run, but in the long run, it will be highly recessionary because it squeezes funding out of especially the SME sector, and it raises systemic risk. Well, some have proposed leaving finance to the market and just let the market sort it all out. Might be fine in theory, but until you start thinking politics, And in a crisis, the government will be forced to step in. So it's better to be prepared. We can change the regulatory framework in some ways, requiring perhaps, as some have proposed, 100% reserves for on-demand deposits and the like. Very costly. Technology might provide the answer, perhaps central bank digital currencies, Web 5, DeFi. Well, that might work in the long run, but it takes a long time to retool the financial system to do that. So instead, I think there are two types of low-hanging fruit the authorities can go after in reforming the system. The first is, at the moment, the way we do regulations is by risk and buffers, protect against the unforeseen. I think it's better to make the system shock absorbent. When a shock happens, make it absorb the shock and not spread it. Current regulations, because they harmonize the way we see risk and they harmonize the way we react to risk, make banks behave increasingly the same, which ends up being as a shock amplifier whenever the shock comes along. That is why systemic risk is on the rise. If you make the financial system much more diverse, you allow new banking models. In the European Union, there's an effective policy that you cannot open a bank. They want fewer banks, not more banks. I think that's absolutely the wrong policy. We need a policy whereby it's easy for fintechs to set up shop, easy to get new entrants in the market with new business models, and not to apply the very expensive regulatory apparatus that you use for the largest systemically important banks to the small banks, as increasingly is a tendency today. So my hope is that we will end up solving the problem by increasing the diversity of institutions, perhaps coupled with more moral hazards. We can solve the moral hazard problem by making the CEOs and senior management of the bank directly exposed to the downside risk. So if the chairman of Silicon Valley Bank or chairman of Credit Suisse had their personal fortunes directly tied up in the success or failure of the banks, I'm sure they would have approached the jobs much more carefully. You don't need a lot of regulations. You need to make the decision makers personally responsible. And I think that's enough, and we can see what type of questions we get.
Thanks, John. So I suggest that each of you takes 5 minutes to react to the others, and then we have a bunch of questions in the Q&A, which I will ask you also. So when you again react to your other panel members, I would like to add one question, which is, some of you seem to think that we have a unique situation and some unique banks are toppling because they were uniquely poor. And others seem to think that this is sort of more a uniform problem, like the savings and loans in the 80s. And there are lots of banks in the same situation. It just takes a bit longer for them to come out. And we may see thousands of bank failures in the US going forward. Could you tell us a little bit whether you see these as crazy one-offs and then how they were dealt with, or whether there will be many more in the same situation, and therefore the regulators have much more work to do going forward? Let's start with Charles.
I think the regulators will have more to do, because what SVB was problematical for was, as interest rates rose, the valuation of its long duration assets, both public and private, went down very sharply. And the degree to which these duration risks, the interest rate risks, were hedged is something that we don't generally know very clearly. I was actually delighted by this conversation, because I think it exposed the points that have not been discussed properly in the press, which is the need for regulatory reconsideration. I think there's a general feeling, which I share, that when the crisis occurred, that both the Fed and the Swiss regulatory authorities did the right thing. And I think that Kathleen is actually exactly right, that this is going to be much more akin to an LTCM moment than to a Lehman moment, because I think that the authorities have headed off a real crisis disaster at the pass. But having said that, I think that they should have never allowed, particularly the Fed, should never have allowed this situation to have developed. There was, as several of you have said, supervisory failures. And I think that we have to actually add the Fed to those who did not meet the underlying natural requirements for overlooking and supervising their own monetary system. And that means that I think that there will have to be a massive reconsideration, including what you do about the risk inherent in holding long-dated government bonds. I think the only thing where I might have a marginal difference is that Kathleen said quite correctly that SVB was unique in many ways. But one of the points about the sort of bail-in process that we have is that the more unique a bank is, in principle, the easier it should be to allow it to fail and use the bail-in process and living wills, because there should be less contagion. The more similar a bank is to lots of other banks, then the more likely it is that when that bank goes down, people will say, well, if that bank is in trouble, then its local compare was in trouble. And you know, when Northern Rock rather got into difficulties in 2007, the reason why it actually had to be saved was that, although it wasn't very large, was that people said, well, if Northern Rock goes, then it'll be Bradford and Bingley tomorrow. And I can't remember which other similar bank the day after. So either contagion or special needs means that every bank now is likely to be supported, as is certainly the case at this moment. And if every bank is going to be supported, we're back with moral hazard and bailout with a vengeance. And as I said earlier, I think the bail-in process has fallen flat in its face. We have to reconsider how it is going to be replaced. And that is not going to be an easy exercise, but I think that this discussion has been extremely helpful in exposing this underlying and, in my view, extremely important issue.
Thanks, Charles. Lutfey.
Thank you. So I think Ron hit the nail on the head when he said that it's really a question of whether there's been a failure of the regulatory regime or the practice, the supervision practice in these cases. Like with all things systemic, it's not possible to point to one cause or one driver. And we know what the proximate causes are, but I think we need to go back down the chain to see what the accumulation of causes would have been. But I think particularly given the reams and reams of regulatory changes that, and the billions of dollars expended in their implementation over the last 10 or 12 years, you've got to ask that the burden of proof is on the regulator to show what went wrong over here. And I think my prior here is that we've been basically acting like the proverbial person looking for the keys under the lamppost because that's where the light is, and not really looking at where we lost the keys. And there is this whole plethora of interaction effects, the softer issues, as I mentioned earlier on, that doesn't get a mention because I guess that is not the domain of people in finance, either on the regulatory side or on the private sector. And I really think we need to talk about those. On the issue of whether it's specific or general, so there's an alpha and a beta, and clearly there are different alphas in each cases. But the beta here is the point I made at the start, which is that the mindset that we acquired over this decade of quantitative easing, for want of a better word, a VC mindset that we brought into everything, a narrative bubble, revenues don't matter, process can be sloppy, it's okay. Whether that has infected various other parts of the system or not, I think is a question to ask. I mean, even right now, the debate about whether the Fed should do a better job on the interest rate side, on the macro side, there's almost an entitlement that the Fed needs to be 100% predictable. And if it's not predictable, if there is flutters in the market, then they're not doing a good job. But actually, by being too predictable, they don't allow financial conditions to tighten, and that defeats the purpose. So I would have thought some bankruptcies, some banks going under is par for the course in this part of the cycle. What I'm absolutely shocked about is the apparent lack of preparedness on the prudential side of things.
Thanks, Lutfey. Who was next? Ron.
Right. Well, this has been an interesting conversation. You know, Charles and John seem to suggest that we have to start from scratch and really think through and rejig the regulatory regime and supervisory regime. Just to take the alternative point of view a little bit, maybe it's more we have to look back at old lessons and relearn them. Anybody who had properly understood what went on in the saving and loan crisis in the 1980s would know about duration risk and know how to spot it in 5 minutes by looking at any kind of decent report of the position of a bank. And it seems that with all the bells and whistles of the new regulatory regime, people relied more heavily on the tools that were introduced after the financial crisis, and seemed to forget some of the basic ABCs of the profession. So I think that a little bit of better qualification of the supervisors might have done something to avoid some of these problems. Now, on the issue about crony capitalism, I think that's maybe going a bit too far. I think that on the other hand, do we have evidence here that the Fed is pretty directly exposed to political pressure? I think the answer is obviously yes. And I think it's possible that the mandate of the Fed and the independence of the Fed was seriously undermined in the last 10 years. And that's maybe one of the conclusions that will come out of this experience. And that giving more protections to the Fed to take difficult decisions based on principle rather than the details of the rules that have been set down might be a sensible response to this, regulatory response to this. So, and on the issue of essentially going for a smaller number of banks and so forth, I think that the issues that were argued for saying that the world has changed and we need to have a financial system that's supportive of the growth opportunities that are being developed out of Silicon Valley and similar, there's something to that, okay? So what I would say is that in some sense, you're always going to fail because the world changes. And we have to be aware that sometimes the system is going to have to be rejigged in light of that. I think that dealing with digitally sophisticated, large-scale investors moving money around very quickly to go into investment opportunities that are presented at a very rapid rate. I think that that's quite correct. And so I think that I would just leave one final thought, and this is for maybe this is aimed at the systemic risk, or it's aimed at all of us. That in the discussions over the last week, you can also find a legal view that this is a demonstration of the failure of the economic view of crisis management. for failing to give a clear indication of the kinds of rules and system that should be put into force. So I think that that's an uncomfortable sort of critic of this, and this has been argued by some legal scholars, that we basically have failed to come up with guidelines for the rules and legal structure, which is inevitably the way a regulatory system is put into place. And I think we have to step back and try to figure out how you have a system that's based on rules, but then you have a system that gives high-level regulators enough room to make judgments about what they're learning about the change of the risks that are being taken on in the economy as the economy changes. So I'll leave it there.
Thanks, Ron. Kathleen. Muted.
Yep, here we are. Sorry about that. I'm going to go into the weeds of bond markets, because underlying the fragility of the banking system is the regulatory requirement that banks hold bonds as capital. So that if the bond market becomes vulnerable to shock, instability, price dislocation, it threatens the entire financial sector. And the basis of every bond regulation, every bank regulation since Basel Accords were first agreed in the 80s, is that banks hold bonds as capital. And I warned in 2019, in July of 2019, that the US Treasury market was vulnerable, was likely to be dislocated. It was dislocated in September of 2019, again in March 2020, and by November of last year, US Treasury liquidity, according to the New York Fed, was as bad in November as it had been in March 2020, when the markets completely failed and screens went dark with no bids. So underlying the problems in the banking sector is bond market volatility, bond market price destabilization, and the fact that banks hold bonds as capital, and banks invest in bonds because they're forced to by regulation. So one of the things the Fed did, at the same time they recognized Silicon Valley Bank as systemic and took Signature Bank into administration, was to roll out a new program, the Bank Term Funding Program. I won't tell you what BTFP means on Twitter, but effectively, BTFP means that you can use your bond portfolios, which on a mark-to-market basis are worth 30 or 40 or 50% less in 2023 than they were in 2021, for 100% at par finance at your friendly local Federal Reserve. Now that's brilliant. That eliminates the duration risk. It eliminates the interest rate risk on all of the bank holdings of bonds in their portfolios. So those 60% of US banks that do not hedge their bond risk, they can now borrow 100%, no problem, they have liquidity. Now, Rajan Patel in the questions asked, why didn't SVP repo out its hold to maturity bonds instead of selling them through Goldman Sachs and taking a 2 billion hit? The answer is because the moment they moved them into the book for repo, they had to realize the 30 to 40% loss on the mark to market. So because those bonds as collateral for the repo would have been marked down 30 to 40%. Now that's what the new Bank Term Funding Program, I always have to look at it because I've got another BTFP in my mind. That's really what that program eliminates, is they can now finance at par for all the government bonds on their books, all the mortgage-backed securities on their books. So that in itself is a revolution. And it happened very quickly and with very little comment. But what it does also do is create a two-tier market by subordinating all of the US government debt and mortgage-backed securities that are held by non-banks, by asset managers, by foreigners. They've just subordinated the rest of the world that bought US treasuries by 30 to 40%. That creates a huge imbalance in the system. And we don't, any of us know how that plays out yet because it's barely being discussed. But to me, that's a really critical feature of the new liquidity program.
Can I just comment on that?
Of course, Charles.
When a central bank acts as lender of last resort, it is supposed to take good collateral with a haircut. Now, what Kathleen has correctly stated is that the central bank is now taking bad collateral with no haircut. And again, this has sort of revolutionized the role of central banks as lenders of last resort. And it's a massive change. And is this really going to persist? And it runs against sort of centuries of views about what a central bank should undertake as an LOLR. And what are your views on that, Kathleen?
Well, first of all, I wouldn't dare to suggest that U.S. Treasury securities are bad collateral.
But they're not. Their market value is not worth their par value.
Exactly, and that's really
it's exactly the same as when you've got a loan to somebody who's going into default. You will get something back, but you won't get face value.
Yes. Well, this is what we're seeing, is that we can have extreme dislocations in the credit system, in the monetary system, made virtually overnight and rolled out without any pushback, without any democratic accountability, without any comment. And none of us know where that leads. We were told that quantitative easing was essential to grow the economy, to stabilize dislocations in the last crisis. Well, no economy with quantitative easing has ever returned to pre-trend growth. Japan has had 30 years of stagnation rather. Europe has never returned to above zero growth. UK has negative growth. US growth is rapidly slowing. So we were lied to about QE. It didn't actually result in growth. And I'm now very wary that new things that are innovated and rolled out at speed are going to have consequences that are unknowable, that won't all be positive.
Thanks, Kathleen. John, your thoughts, and also Angus Armstrong has asked a question, I think specifically for you on the Q&A sheet.
So your JP, your question was first about the uniqueness of these banks, and of course the Silicon Valley Bank and Credit Suisse were quite unique in their own way. Silicon Valley Bank with a unique business model and how badly managed Credit Suisse was. But there's another thing to come out of this. Just this morning, I was reading an article in risk.net where they rank European banks based on the sensitivity to rising interest rates. So you can so of course, this is something a lot of people are doing now. So now all sorts of experts are plowing into the bank's disclosures to identify who is the riskiest. And with the speed of the internet and social media, that could quite well lead to the downfall of several more banks at a speed the authorities can't react to. And that really reinforces Charles's point earlier, which is that by making the banks so similar, they're all vulnerable to the same risks. And that's exactly one of the issues of why we think more diversity is useful. But I'm listening to the other panelists, and I would like to ask Kathleen and maybe Ron a question about this, but mostly Kathleen, which is about these crony capitalism and rules. Now, there is in regulations, like almost everything else, there's a desire to change the world into what we want the world to be, rather than recognize the world as it is and try to make the best of it. So we can complain endlessly about crony capitalism and rules and whatnot, but a big part of this is human nature. And what happened in Switzerland and with Credit Suisse, what is most fascinating is that when politics meets rules yield. So both the US and Switzerland, they essentially had a political resolution done at the highest possible political level. And when you get into that situation, who cares what laws you have? Who cares what rules you have? Because the governments can always change the laws and they can always change the rules. However, I mean, the United States also has been very successful. It has created a huge number of tech firms. The Silicon Valley Bank was instrumental in allowing the Silicon Valley to be the center of the world's technology. So something must be good about this setup. So Kathleen, could I maybe ask you to say something about, could this crony capitalist setup the US have, is there a positive side to it that maybe we should move in that direction here in Europe? And I have a quick question for Charles. So you were discussing the recognition of the risk in government bonds. Is there any analogy with what happened with Silicon Valley Bank and the Cypriot banks 10 years ago and their exposure to Greek government bonds?
The answer is yes.
Kathleen.
John, can you first answer? Sorry, Kathleen. John, can you first answer Angus's question about the diversity? And some other questions said the opposite. Maybe we should just all go to boring narrow banks that make them all exactly the same. So I guess that's also for you, John.
The issue is about diversities. We used to have a much more diverse banking system in the UK and elsewhere, and then we moved into making it more and more homogeneous. It is not the entry as such, because if you allow the entry of a new bank that is exactly the same as every other bank, it doesn't help much. What we need is, and I think this is where we need more flexibility from the regulators, we need new banks to be allowed to operate where they have new business models and look different from the existing banks. So when granting licenses to operate, my impression is, by talking to people in the sector, is it is really difficult to set up shop unless you look exactly like everybody else in the system. And that's what we can change.
But John, if Silicon Valley Bank was so great in helping Silicon Valley become successful, and now it's just a transfer from the government to Silicon Valley Bank, why is that a great thing? Why not then directly subsidize these industries? Why do it through a failing bank and then bear the cost later on? Why not set it up rigorously and permanently from the start?
Well, if the government is going to fund investment, you will get the worst possible politically driven investment imaginable. This is exactly what the private sector is meant to do. But I think the bailout of the Silicon Valley Bank by the US authorities was a fairly big mistake, and it will come back to haunt Biden in the next presidential elections, because he promised over 10 years ago no more bailouts, and it just did one. So I think it's a political mistake and an economic mistake. However, my question to Kathleen was, is the existence of a bank like the Silicon Valley Bank, with all its crony capitalism, connections to billionaires, as you highlighted, all taken together, is it good or bad for the United States?
I don't think that's a question for me to answer. I mean, I did point out that there is a political question, whether it's better to have 4,800 banks or whether to have 5 banks. But there's a lot of space and optionality between 4,800 and 5. So ultimately, it is going to be politically decided. I mean, what does worry me is what Charles highlights, which is that we keep changing the rules without changing the system. Because, as you correctly point out, when it comes push to shove, and billionaires call regulators and call legislators, billionaires win. And the rules get pushed aside in favor of something that maintains the integrity of the system, regardless of the rules. So we have spent 15 years working on these new rules. We've rolled out, like 40,000 pages of Basel Accords. And what does it actually mean?
No, I think I couldn't agree more. That's exactly was the theme of my talk, was exactly that reality. I think the question, at least for me, is, given that reality, and given we have the politics and all the other issues you raise, how should we set up a system that's robust to that? Because we can't change people, we can't change politics. So
Answer.
What?
I have an answer to that. I want to restore wholesale liquidity to bond markets. The reason the Treasury market is failing is because the regulations that the Fed and the SEC have rolled out into the Treasury market, things like post-trade transparency, central counterparty clearing becoming mandatory, the all-to-all model, God forbid. They destroyed liquidity in the deepest market at the heart of global capitalism, so that there is now no longer wholesale liquidity in treasuries. They are no longer the risk-free asset, because not only do they have duration risk, they have liquidity risk, because you can't actually sell 22 billion of bonds in a day without moving the price. 10 years ago, you can't anymore. So what I would like to do here in the United Kingdom, as long as we've got the self-inflicted harm of Brexit on us, is abandon IOSCO, abandon the BIS, and restore wholesale bond market liquidity at the heart of global capital markets.
But even if you restored liquidity, you would still find that the movements in interest rates, which were both large and generally unexpected, would have caused severe problems to the banks. I'm all in favor of improving the liquidity of the bond market, but I don't think it actually would have been an answer to our present problems. But JP, I fear I must leave now. So,
thank you very much, Charles.
Okay, bye.
Bye, Charles.
Does anybody want to address the Sushil Vadvani's question about Credit Suisse? I think their CDS spreads were around like 10% probability of default in October 22.
Yeah.
Was that a missed opportunity, or was that just markets being crazy? Well, they turned out to be right in the end. What would have been the appropriate reaction at that moment?
Ooh, I was at the Global Funding and Finance Conference in Luxembourg just before Credit Suisse blew up in October. And one of the interesting things that somebody recently observed to me about both SVB and Credit Suisse is that they were disliked. They were not popular. They were both considered marginal, and the other banks didn't like them, which is one reason why when they got into trouble, the trouble just got worse. Had they been liked, had they been popular, had they been mainstream, maybe the other banks would have rallied around them, provided liquidity. But because they were unpopular, they were already in trouble, they had already broken a lot of the rules and gotten away with it, the other banks let them hang.
So you're saying banking is like high school?
Yep.
Lutfey.
Again, if I could caveat it with, hindsight is 2020, and this is all speculation, and I've no way of knowing exactly what the situation was then. But from the outside, I go back to where I started, which is banking. There's it used to be a lot about relationships, about leadership, about communication. If you look at what Dr. Axel Weber did for UBS at a crucial point in time in their journey, I couldn't see that kind of leadership. The commentary and the language and the slides have all been about we're cutting costs, we're improving ratios, we're bringing in capital from the Saudis, which they did. So I think the CFO did a great job from the engine room in bringing in capital. But, I think you also need to do that outreach and the charm offensive. Confidence doesn't improve if there is an extra percentage point of improvement in the capital ratio. And I think that is where what was going on with their relationship managers, were staff too terrified of the chops that were coming to actually help manage relationships. What are the interfaces? Good luck with a robo-advisor trying to keep your depositors with the bank when you really need those relationship conversations to be had. That level of microstructure detail is, I think, what the supervisor should have been asking at that time.
No, Lutfey, I couldn't agree more. I was sort of if I can paraphrase what you're saying culture matters. So some banks are simply a better risk culture than others. And the Archegos crisis 2 years ago shows exactly how important culture is. Two banks sold immediately, two of the prime brokers sold immediately. In Credit Suisse, you said they had endless meetings to discuss what they should do. And by the time they could make up their mind, the market had moved against them. They lost a couple of $1 billion. Culture. So that if that is true, Lutfey, how can the authorities think about culture?
So as I started off by saying, I think we do need to bring in the domain experts from behavioral science. They're not in the core of the discussion in finance. but including the department at LSE, they have some things to say. There are certain biases that you can be mindful of in advance. There are good ways of modifying culture and bad ways of doing them, and tracking them as well as we go along. There is, of course, I mean, this needs to be looked at, so I'm not suggesting an answer, but I would go in that direction. For me, the composition of the board and the executive board is a question that we need to ask about. In both UBS and CS, there has been a tremendous amount of cross movement of leaders, of individuals from one to the other, horizontally, diagonally between the exco and the board. And this has happened way back in time as well, when Zigrand was appointed CEO of UBS in the first attempt at reform, which wasn't probably very successful, and then there were subsequent attempts. So it is the almost the anthropological and the behavioral science models that I think we need to bring to bear when we talk about.
So in October last year, Lutfey, you're saying that the regulators or somebody should have said, look, the bank is in trouble. We need to have a new board, a new chairman, a new CEO, or what would you have?
Or just ask, what are you communicating credibly and authentically about the culture changes that you've undertaken? Because clearly with Grinsil and Archigos and the others, there clearly should have been, and I'm sure there was, a recognition that there are certain cultural changes that needed to happen. And how do you get ahead of that narrative? Who is communicating with the key depositors? When we say there have been withdrawals of assets under management and from the private bank, who is on the front foot doing that communicating? As opposed to, as I was saying, much of the dialogue was about cost-cutting, efficiency, someone with the moniker of the knife and that sort of stuff, as opposed to, was there enough diversity in that leadership team where some can take care of the engine room while some go out and look at the external relations, which again, I thought Dr. Axel Weber did very well at UBS.
Thanks, Lutfey. Ron, yeah.
So if I could just give a couple of thoughts about how you can have a vibrant growth sector coming out of Silicon Valley or the equivalent, and still have a stable banking sector. I guess this calls into question the changes of since the elimination of Glass-Steagall. And if you want to put it in an extreme way, it raises the prospect, should we be evaluating a system where we have something like narrow banking supported by the authorities and supervised, providing basic banking services essential to the economy, and then having private banking, investment banking done in entities that are separate from the banking sector. I don't have exactly an idea in mind, but maybe that's where the answers might be found in this changing circumstance.
Thanks, Ron.
Ron, can I interject a little bit? I think
Okay, John.
I fully agree with what you just said, and I think our idea of diversity in the system exactly embraces that concept. So there is much to learn about how banks regulated in times past, because we had much more diverse flora of banks, which made them more resilient than they are now. So that is certainly consistent with our vision of bank diversity.
One question in the Q&A is by Robert McRae, who asked, okay, so now we've used immediately all our systemic toolkits and we use the systemic exceptions and so forth. What would have happened had we not done that? Did the regulators, policymakers overreact, maybe because of political, pressures and so forth? But if they hadn't done that and just, followed the rule books, do you think something worse would have happened and this was the right thing to do or not? Ron?
I think that if they're successful, it will look like they did the wrong thing, because it will say it wasn't necessary. But I think the fact of the matter is the way they reacted, they basically recognized at the highest level that we don't know what's going on here. So this is not meant to be a precedent for all time. But we have to get to the bottom of this, and we need time to do it. And the only way we're going to get time is we invoke this systemic exception.
JP, can I react to that quickly as
Yes,
well?
please, John.
So just to echo on Ron's answer to that, what we have been seeing is the authorities have been using an increasing range of tools to fight the crisis around them since 2008. And I think the authorities are running out of powder. So it's increasingly hard to react to the next crisis. So even though, I mean, it is politically much more difficult to do a bailout today than it was then, and there will be consequences in Switzerland and the United States, which were not 15 years ago. The fiscal position of governments is much worse. The monetary position is much worse. So the tools they've been using, they have exhausted the dry powder used to fight crisis, but the crises keep on coming. So I think that's one part of the failure of financial policy over the past decade and a half.
Yeah, can I add to that? I'd like to put this in a global context, because one of the things that I've observed in the last year that's very unpopular is that the Federal Reserve is now a price taker. They're no longer the price maker of money, because there's a whole world out there that's trying to move away from dollars and trying to finance and other things. 2 days ago, we had the launch of the Petro Yuan, when President Xi was in Moscow with President Putin, and President Putin invited the world to buy Russian oil, Latin America, Africa, Asia specifically, in yuan. And of course, President Xi made the same invitation to the Gulf Cooperation Council at the summit in Riyadh on 9th of December. The world is changing rapidly, moving away from the West towards the East and the South, which are unifying, and peace is breaking out all over. The Saudis have peace with the Iranians. The Indians and the Russians are resolving their border dispute. Or rather, India and China are resolving their border dispute. And they're doing it without the West. They're doing it by themselves. And they are changing what money is going to mean, because they're diversifying away from dollar. Now, that means that rates are going to react. Inflation is going to react. And I don't think that we've really had this discussion in a grown-up way, because it's so scary. I think we need to start having the discussion about how we manage this in a logical and rational way, and not just call names about democracy, dictatorship, or whatever, because I think that's ridiculous. The reality is that 50% of the global economy and 85% of global population are in economies that are trying to move away from dollar. And that means that the Fed has got a huge challenge on its hands besides just the fragility of the US banking system and US bond markets. And so I think we do need to just every now and then step back, take a look at the big picture, and bring in a longer term perspective on what's happening in the global economy. Because the Fed is not unilateral anymore. It is not a unipolar world.
Any reactions to Kathleen's view?
I mean, I am not as pessimistic as Kathleen is, and
I'm not a pessimist. I'm an optimist.
it is.
I think it's great.
I am okay. No, I'm then more of an optimist. I value the system we have, and I value democracy, and there is, of course, we always have had bipolar systems. There never has been a single monolith in the world, and of course, we are moving away, or some countries are moving away from the dollar. But I think a lot of countries will ask themselves the following question: when the crisis started last week, the Fed emphasized the swap lines it has with foreign central banks, and it's facilitating the use of dollars. Would the Chinese central bank behave in the same way in a crisis? And if you do not think the Chinese central bank would behave the same way in a crisis, that will then make countries reluctant. So there's a lot of issues that have to be there's a lot of comfort that countries need to have before they move wholesale into the slightly nightmarish vision that you're outlining.
Do you know what? Swap lines are exactly why I dislike the existing system. The Fed has 4 permanent swap lines: Japan, ECB, Swiss, UK. In 2020 and in 2009, they rolled out emergency swap lines, but just to 9 countries and on the basis of political allegiance to the United States as the criteria for giving swap lines. It's a discriminatory, damaging system for the rest of the world. And by the way, China has more than 40 swap lines. Now, whether they're going to be used hasn't been tested because there hasn't been a crisis in China that's destabilized the Chinese system yet.
I guess what it just highlights is that there's another dimension to the already set of multiple dimensions that the regulators, each of these regulators needs to optimize on. Can I ask a question, JP? Could I, or does anyone want to say on this topic? So it's really to do with the founding ethos of the Systemic Risk Center here, which is that virtually all crises that matter are not because of an asteroid hitting from the outside. It's the accumulation of small things over time, your endogenous risk, as you guys like to call it. And many of the behavioral things that I'm talking about are also really manifestations of those things. It's the transmission channel for systemic endogenous risks to build over time. And again, over here, I find a discontinuity in the script of what has happened, especially with Credit Suisse. If historians looking back had to answer the question, what caused Credit Suisse to get to this stage? I don't know what they would say. What is the answer to that question? And I guess the right answer is it's been an accumulation of a lot of different things. So my question is are there better ways for regulators to stay on top of the markers of these endogenous feedback loops going out of control too early enough, or are they by definition unanticipatable, therefore cannot be regulated against?
Maybe I can start. So, one problem we have in regulation is the micro versus macro prudential regulation. Any one regulator looking after any one bank will have no incentives and not in their mandate to ask questions about what would this mean for another bank, for a bank connected, for creditors, debtors, and so forth. So there are good and bad reasons for that, but that is not the remit of a microprudential regulator. And I think, therefore, having this thinking, having the awareness of further consequences is very important, and maybe have to be put somehow into the mandate of the micro regulators. And that is definitely not the case now. I know that some central banks are very advanced on this thinking. I know the Bank of England has lots of teams trying to team up. So their insurance guys and their bank guys, they talk to each other, the fund guys, they try to get an overall view, and what I see in my domain, how would that spill over in others? So that thinking has taken hold some places. But in the microprudential regulatory arena, that has not happened, and that it could not have happened yet. My view, John.
No, I'm not going to comment.
Can I move on to the next question, which is related to this question, which is Alessandro asked a question about marking to market. So, we've had these discussions over years, and now we came back full circle to that question: is marking to market good or bad? Here, in this case, not marking to market was bad, but now marking to market would be bad. So is marking to market sometimes good, sometimes bad? What do we make of that? Ron.
Well, you shouldn't try to market things that don't have markets. And unfortunately, what we find, and here, as was pointed out, even in treasuries, is meant to be the safest, most reliable and liquid sort of market, has had periodically very difficult periods when the markets sort of disappear, they're very illiquid. And so inevitably, we're going to have to deal with this and say, okay, some things, for example, we didn't talk about it in a very specific way today, but you raised the question in particular about hold to maturity securities and available for sale. And in the case of SVB, they had very liquid material, liquid assets, or relatively liquid treasury assets that they categorized as hold to maturity. But they were only a hold to maturity so long as the run didn't happen. When the run happened, you had to sell them, and then you sold them at knockdown prices. And so that's the difficulty. And this the liquidity in the market moves around. You know, markets change all the time. And so this is forever going to be a difficulty for accounting standard boards and regulators to sort of get their heads around, because it's a moving target. And I think we just have to face that. That's the reality of it.
So Ron, so why not then have two sets of accounts? You have the actual accounts that you need to file and you pay your taxes on and what have you. And then you have prudential accounts, because surely most banks, and somebody asked this question, I forgot who now, I think Robert McGray asked the question. I think most banks, at least in the Eurozone, which I know better, are actually hedging their assets. So even if they hold fixed bonds on the asset side, they are still, because of delta EV conditions and so forth, they are actually hedging and swapping them into floating rates. So internally, some banks actually are marking to market their portfolio for risk purposes and for asset liability management purposes, even though the accounts as stated and given to the accountants to review are not hold for sale. They're held to maturity. So why not have this, require the risk guys to actually pretend everything is marked to market, but maybe not the official accounts for whatever reasons? Is that silly?
It's not silly, and in my experience, and this is a little bit dated experience, some very large banks do have exactly what you described. They've got one set of books for used for the preparation of their regulatory filings, so the others that they use for managing risk, maybe of the group as a whole. Maybe the regulatory, the bank, the regulated bank is one entity, and then the group as a whole might be doing the hedging. But that doesn't solve their headaches. It just gives them a new set of headaches, because you've got to reconcile the two. And sometimes you've got to take securities that you thought you would be holding to maturity genuinely, and you for either for strategic purposes or business purposes, or for liquidity purposes, you've got to call upon them, and things change. And you're going to present the next year you see the regulators, they're going to say, wow, how'd that happen? Because you've changed enormously.
We have one more question, which was the control functions. Where were the control functions, and what could have been done about the control functions? I think we talked about it a little bit, but let's just maybe, Lutfey, this is also your thing. Do you have any views on where were the control functions?
I clearly don't know in specific terms, but I think it's almost too easy to put too much of the responsibility on the control functions, and then they in turn provide a fig leaf to what's really part of the business function. The revenue side of the equation and the risk side of the equation should be part and parcel of the same thing. And so I think it is really about the culture, the design of the processes, the lines of defense that they would have. In the specific case in Switzerland, I've read how they've had changes in the roles of the head of compliance, which would suggest from the outside that perhaps they turned it into a personality issue as opposed to a process or a culture issue. So I think we cannot hide away from the role of culture, the role of organizational purpose as part and part of strategy. And then within that, the role of a function, one of which is control. But the big picture it's got to start from the point of culture first.
Thank you. Who wants the last word? Kathleen, do you want the last word?
What I will say is I'm glad we've got Andrew Bailey as governor. I'm glad HSBC stepped up to the plate to take SVB UK, because fintech and tech has been the dynamic part of the economy since 2008. There isn't a lot else to celebrate. And losing half of that sector over a weekend would have been catastrophic. My CFO has another company. They had just raised 30 million in funding, and it was all in SVB UK. And that company, which is a science-based company out of Cambridge, would have been wiped out. The founders would have been destroyed because they also had personal accounts in SVB UK. So, you know, here in the UK, I do celebrate. We managed to get the job done, resolve the crisis over the weekend, and I'm grateful to HSBC and Andrew for doing that.
Kathleen, am I allowed, JP, to interject a little bit into Kathleen's comments? So I take the opposite view. When I saw when the Silicon Valley Bank was failing, when I saw the heads of the technology companies, people worth hundreds of millions, billions of pounds, all saying, "Please, government, give us money. Don't fund the NHS. Fund us." I think that is just not the way this system is supposed to work. If you are a company worth that as much as you say they were, why can't you do the least due diligence on the bank that you are doing business with? Perhaps diversify where you keep your money. And there has to be some responsibility for the firms that deposit money with banks. What you are really proposing is you're proposing one of two things, both of which I dislike. You're proposing, because technology is so important, the government needs to support it, or you're proposing to protect everybody. But
there was no public money that went into HSBC to make this happen.
The heads of these companies, they all wrote to the government and said, "Please bail us out." And the Chancellor of the Exchequer said, not the Bank of England, but the Chancellor said, "We will bail them out." So I mean, if it had been handled sort of on the quiet by the Bank of England doing it, it would have been much better than having the Chancellor do it in the way he did it.
I'm just going to say, thank goodness we have a governor that's more discreet and more rational than our chancellor, because the governor did it without a public bailout.
On that note, I will cut this short. I thank all of you for taking the time to be on this panel. I thank all the participants for all their questions. Fantastic panel. Thank you very much, all of you. Well done.
Thank you.
Thank you all. Thank you, JP. Bye-bye.